Welcome to my presentation on mortgage-backed securities. Let's get started. And this is going to be part of a whole new series of presentations because I think what's happening right now in the credit markets is pretty significant from, I guess, a personal finance point of view and just from a historic point of view. And I want to do a whole set of videos just so people understand, I guess, how everything fits together and what the possible repercussions could be. But we have to start with the basics. So what is a mortgage-backed security? You probably read a lot about these. So historically, let's think about what historically happens when I went to get a loan for a house, let's say 20 years ago. And I'm going to simplify some things, and later we can do a more nuanced. But let's say I need, where'd my pen go? Let's say I need $100,000. No, let me say $1 million, because that's actually closer to how much houses cost now. Let's say I need $1 million loan to buy a house, right? This is going to be a mortgage that it's going to be backed by my house. And when I say backed by my house or secured by my house, that means that I'm going to borrow $1 million from a bank, and if I can't pay back the loan, then the bank gets my house. That's all it means. And oftentimes it'll only be secured by the house, which means that I could just give them back the keys. They get the house, and I have no other responsibility, but of course my credit gets messed up. But I need $1 million loans. The traditional way I got $1 million loan is, I would go and talk to the bank. This is the bank, and they have the money. And then they would give me $1 million, and I would pay them some type of interest. Probably, let's just say, I'll make up a number. I mean, the interest rates obviously change, and we'll do future presentations on what causes the interest rates to change. But let's say I would pay them 10% interest. And for the sake of simplicity, I'm going to assume that the loans in this presentation are interest-only loans. In a traditional mortgage, your payment has some part interest and some part principal. Principal is actually when you're paying down the loan. The math is a little bit more difficult with that. So what we're going to do in this case is assume that I only pay the interest portion, and at the end of the loan, I pay the whole loan amount. So let's say that this is a 10-year loan. Let's say it's a 10-year loan. So for each year of the 10 years, I'm going to pay $100,000 in interest, $100,000 per year, right? And then in year 10, I'm going to pay the $100,000, and I'm also going to pay back the $1 million, right? So if we think about it from, let me just year 1, 2, 3, 9, 10. So in year 1 I pay $100,000, year 2 I pay $100,000, year 3 I pay $100,000, year 9 I pay $100,000, and then year 10 I pay the $100,000 plus I pay back the $1 million. So I pay back $1.1 million. So that's kind of how the cash is going to be transferred between me and the bank. And this is how I don't want to say traditional loan because this isn't a traditional loan, an interest-only loan, but for the sake of this presentation, I want to how it's different than a mortgage-backed security. The important thing to realize is that bank would have kept the loan. These payments I would have been making would have been directly to the bank, and that's what the business that historically banks were in. Another person, you, and you have a hat. You would, let's say you're extremely wealthy, and you would put $1 million into the bank. Right? That's just your life savings, or you inherited it from your uncle. And the bank would pay you, I don't know, 5%. The bank would pay you 5%, and then take that $1 million, give it to me, and get 10% on what I just borrowed, and then the bank makes the difference, right? It's paying you 5%, and then it's getting 10% from me. And we can go later into how they can pull this off, like what happens when you have to withdraw the money, et cetera, et cetera. But the important thing to realize is that these payments I make are to the bank. That's how loans worked before the mortgage-backed security industry really got developed. Now, let's do the example with a mortgage-backed security. Now, there's still me. I still exist. And I still need $1 million. Instead of going to the bank, or actually, let's say I still go to the bank. Let's say I go to the bank. The bank is still there. The bank is still there. And like before, the bank gives me $1 million, and then I give the bank 10% per year. Right? So it looks very similar to our old model. But in the old model, the bank would keep would keep these payments itself, and that $1 million that it had is now used to pay for my house. Then there was an innovation. Instead of having to get more deposits in order to keep giving out loans, the bank said, well, why don't I sell these loans to a third party and let them do something with it? And I know that that might be a little confusing. How do you sell a loan? Well, let's say there's me, and let's say there's 1,000 of me, right? There's a bunch of Sals in the world, right? And we each are borrowing money from the bank. So there's 1,000 of me, right? I'm just saying any kind of large number, doesn't have to be 1,000, right? And collectively, we have borrowed 1,000 times a million. So we've collectively borrowed $1 billion from the bank. And we are collectively paying 10% on that, right? Because each of us are going to pay 10% per year. So we're each going to pay 10% on that $1 billion, right? So 10% on that $1 billion is $100 million in interest. So this 10% equals $100 million. Now the bank says, okay, all the $1 billion that I had in my vaults or whatever, and I guess now there's no physical money, but in my database, this is now out in people's pockets. I want to get more money. So what the bank does is it takes all these loans together, that $1 billion in loans, and says, hey, investment bank, so that's another bank, why don't you give me $1 billion? So the investment bank gives them $1 billion, and then instead of me and the other thousands of me paying the money to this bank, we're now paying it to this new party, right? I'm making my picture very confusing. So what just happened? When this bank sold the loans, it grouped all of the loans together, and it sold it in a big it did it on a wholesale basis. It sold 1,000 loans to this bank. So this bank paid $1 billion for the right to get the interest and principal payment on those loans. So all that happened is this guy got the cash, and then this bank will now get the set of payments. So you might wonder, why did this bank do it? Well, I kind of glazed over the details, but he probably got a lot of fees for doing this, or maybe he just likes giving loans to his customers, or whatever. But the actual right answer is that he got fees for doing this, and he's actually probably going to transfer a little bit less value to this guy. Now, hopefully you understand the notion of actually transferring the loan. This guy pays money, and now the payments are essentially going to be funneled to him. I only have 2 minutes left in this presentation, so in the next presentation, I'm going to focus on what this guy can now do with the loan to turn it into a mortgage-backed security. And this guy's an investment bank instead of a commercial bank, and that's important. Well, that detail is not that important in understanding what a mortgage-backed security is, but that will have to wait until the next presentation. See you soon. Welcome back. So where we left off is there was 1,000 people who all needed, let's say, $1 million loans each, and they were all going to pay 10% on their loans. And they borrowed it from this bank. It's kind of a standard commercial bank. And this bank says, well, I just handed out $1 billion, and I'm getting these interest payments, and my vaults are empty. I want to have money back in my vaults, or I want to have money back on my balance sheet. So I'm going to sell these loans. I'm going to bundle them all together and sell them to this investment bank. And now, what is this investment bank going to do with these loans, and why is it doing it? So let me delete this. So we had the investment bank. I randomly picked the color green, but I think it is appropriate for the investment bank. So now I have all of the, me. That's a little smiley face. There's 1,000 of me, and we are now going to pay the 10%. We're now going to make all of our mortgage payments, the 10% payment, to this bank, this investment bank. But the investment bank, they're not in the business of servicing loans or keeping loans on their balance sheets. So what they do is they create a corporation. They create an entity, though, maybe a special purpose entity, whatever you want to call it. So they create a company. Let me make that in purple, another color. So they create this company. And what they do is they will take this $1 billion, well, no, not the $1 billion. They take their rights to these payments that they got, right? They paid $1 billion to that first bank in order to get the payments from all of these people. And they say, you know what, the rights on those payments, right? That's the asset. They bought all these loans. The rights on those payments, we are now going to transfer to this special purpose entity, to this other corporation. So now everyone is going to essentially all their money, all their mortgage payments are going to be funneled into this entity, right? And this is a corporation, and so what the bank will do is issue shares in this corporation. So let's say that it issues, let's say for simplicity, 100 shares. So there's 100 shares. 100 shares. So what's in this corporation? There's the entire corporation gets the mortgage payments on the $1 billion in loans, right? It has $1 billion of loans outstanding, and it's going to get 10% a year. So it's going to get 100 million per year, right? Because it's 1,000 loans out there. It's going to get 100 million per year for 10 years, and at the end of the 10 years, it's also going to get $1 billion, right? That's its asset it has. Its asset is the rights on those payment streams that are going to come into this corporation. And then it has 100 shares. So the way I think about it is you can split this company 100 ways. And I'm doing this to further confuse you. So what is each of those, the owner of each of those shares, what does it entitle them to? Well, it entitles me to 1/100th of what this corporation gets. So each share, so if I have a share, let's make it look, it looks like a share, a stock certificate, I'm going to get 1/100th of this thing. And normally you wouldn't have 100 shares. You would have, let's say, 1,000,000 shares. Actually, let me make it 1,000,000 shares because I think that's in some strange way more realistic. So let's say there are 1,000,000 shares. So if there are 1,000,000 shares, each share will get 1/1,000,000th of the cash flow stream that's entitled to this entity. So instead of getting $100 million every year, it gets 1/1,000,000th of that. So it gets $100 per year. And then on the last year, instead of getting $1 billion, it gets $1,000. So what the bank will do is it'll take these shares and then it'll sell it to the general public. It'll IPO it essentially. You can think of it that way. And tons of people will buy it, especially hedge funds and pension funds and mutual funds and bond investors. And it's just important to think about how the money is flowing. So now when they sell these shares in this entity, people are going to give them, well, hopefully more than what they paid for it, right? Maybe there's a lot of demand for this type of asset where I get this type of income stream. So maybe once they sell all the shares, they get, I don't know, they get $1.1 billion for them, right? So this is the investors. And the investors collectively buy these shares for $1.1 billion. Essentially, let's say they paid $1.1 billion for 1,000,000 shares. So they paid $1,100 per share, right? $1,100 per share. Each of the investors paid $1,100 for each of these shares. So then $1.1 billion goes into the special purpose entity. And if you think about it, the bank made out like a bandit, right? Because the bank paid $1 billion for the rights to these mortgage payments, and it's getting $1.1 billion from the investors. And all the bank has to do is kind of set this whole legal structure up and service the loans. It actually doesn't even have to service the loans. We'll go into that later. So let me summarize, I guess, just because I know this can be a little bit of a daunting subject. Let me summarize. So, and let me use this purple. I don't like. It's a little bit. Anyway, so you have tons of investors. So each of these is an investor. I know, actually, a borrower. All of these people need to buy houses. These are all smiley faces. These are all smiley faces, right? They all need to buy houses, and then they collectively get $1 billion, right? $1 million each, and they each use that $1 million to buy their house, to buy their relative house. And then that $1 billion initially came from, just their local bank, and then. And when the $1 billion came from that local bank, all the payments, the interest payments, went to the bank. But then an investment bank came along and said, well, no, I want to buy the rights to those payments. An investment bank came along and says, well, I'm going to give you $1 billion, $1 billion. And now, instead of you getting the payments, I get the payments. And then the bank sets up a special purpose entity. Essentially, it sells a bunch of shares. Let's say it sells 1,000,000 shares, 1,000,000 shares, And let's say it was able to sell each of those shares for $1,100, right? From the investing public. So it's able to sell each of them for $1 million. So it raises $1.1 billion, right? So the value of this company is $1.1 billion that now goes to the bank. And now the payment stream, instead of going to, let me do a different color. Now the payment stream goes to the special purpose entity instead of the bank. And the bank essentially made out like a bandit because it paid $1 billion and it got 1.1, so it made $100 million just for doing this transaction. I'm not saying that's how much a bank actually would make, but this shows you why every person is kind of what they're doing in this value chain. And as I said before, this bank also probably did something similar. They probably took some fees or sold the loans for slightly more than they issued the loans for. So these shares, each of these 1 million shares, these shares that I said, this is a mortgage-backed security. Mortgage-backed security. And it makes sense. It's a security. A security is an ownership that's tradable in a company. And that company has the right to payments that are secured by mortgages. So if all these people promise they would pay, and they're going to pay to this special purpose entity, but if by chance one of these people lose their jobs or they can't pay or for whatever reason, instead of the payments, this entity is going to have the rights to their property. And that's why we say that it's a mortgage-backed security. So it's not just a promise to get money. The money is actually backed by people's mortgages. And of course, then this entity is going to, if this guy defaults on his loan, he's one of a million. So statistically, you might be able to predict that. I don't want to put too much stock in these statistical models. Then this entity will just have that property auctioned off or sold, and then it'll just, the cash flow will come back to it. So that's what a mortgage-backed security is. Hopefully I didn't confuse you too much. My next presentation, I'm going to take it to a further level of confusion and show you what a collateralized debt obligation is. And then I'll do a more philosophical video on why these things even exist and why they're useful and why people may benefit or may not benefit from these things. Welcome back to my series of presentations on mortgage-backed securities. So let's review what we've already gone over. So I've already drawn here. I actually prepared ahead of time. So I've already drawn here kind of what we've already talked about. So we started with borrowers who need to buy houses. Each of them borrowed $1 million. So actually, let me write that down. Let me change the color of my pen. Where'd my pen go? There it goes. Okay. So each of these people borrowed $1 million. 1 million. Oh, that's too fat. I don't like that pen. Where's the thinner pen? Okay. Each of them borrowed $1 million, and there were 1,000 of them, right? So $1 million times 1,000, that's $1 billion that they needed. And then they said that they would pay 10% a year on that money that they borrowed. So that's 10% for each of them is $100,000. And then, as we said, there's 1,000 borrowers. So they're going to put in $100 million, right? 100,000 times 1,000 is 100 million. So just to simplify, keep it in your mind, $1 billion goes to a bunch of borrowers, goes to 1,000 borrowers to be specific, and then each year those borrowers are going to give the special purpose entity. This is just a corporation designed to kind of structure these mortgage-backed securities. They're going to give 10% of the billion, or $100 million back into this. And then we said, okay, well, where does that money for this special purpose entity or for this corporation comes from? Well, it comes from the investors in the actual mortgage-backed securities. So let's say that there's a, and just to be clear, so the asset within this entity is the loans, or are the loans. Let me see. Where did my pen go? So loans. The loans are the main asset that's inside of the special purpose entity. And the loans are just the right on these 10% payments. And so the money came from when the owners of each of these mortgage-backed securities, each, let's say, paid $1,000 for the mortgage-backed securities, and in return, they're going to get 10% on their money. So each security costs $1,000, and then they're going to get $100 back per month. And we said there are 1 million of these securities. So $1,000 times 1 million, that's where the $1 billion comes from. My thing's been acting up. That's where the $1 billion comes from. that essentially is lent to the borrowers. And these guys will get 10%. Now, one thing I want you to keep in mind is they get 10% only if every one of these borrowers pays their loans, never defaults, never prepays. Prepaying a mortgage is just saying I sold a house, so I don't need the mortgage anymore, so I just pay it off. So it's only 10% indefinitely if all of the borrowers pay all the money and never default or anything like that. So this 10% is kind of in an ideal world. Well, everyone knows that it's not going to be exactly 10%. Some percentage of these borrowers are going to default on their mortgage. Some of them are going to pay ahead of time. And actually, that's what the buyer of the mortgage-backed security should try to figure out. And all sorts of buyers are going to have all sorts of different assumptions. And this is what you've probably read some articles about these hedge funds with these computer models to value their mortgage-backed securities. And that's what those computer models do. They try to look at historical data and figure out, okay, for a given population pool in a given part of the country, what percentages of them are able to pay off their mortgage, what percentage of them default on their mortgage, and when they default, what is kind of the recovery? If say they default on $1 million mortgage, and then the special purpose entity would get control of that house, and then if that house is sold for, I don't know, $500,000 because the property value went down, then the recovery would be 50%. So that's all of the things that someone needs to factor in when they figure out what will be the real return. 10% is if everyone pays. So let's make some very simple assumptions for ourselves to kind of, let's say we are thinking about investing in a mortgage-backed security and we want to gauge for ourselves what we think the return is going to be. Well, let's say we know that this pool of borrowers that, let me see, that my pen keeps stop working, that 20% will default. 20% will default. We're not going to worry about prepayment rates and all things like that. Let's say 20% are going to default, and then on those 20% that default, so these are, of these 1,000 borrowers, 200 of them are just going to lose their job or whatever. They can't afford a mortgage anymore. And of those 20% that default, we have a 50% recovery. 50% recovery. So that means, borrower X defaulted on his loan. And then when we go and get the property, because the loan was secured by the property, and when we auction off the property, we only get $500,000 for it. So we get a 50% recovery, 50% of the original value of the loan. So if 20% default, and then there's a 50% recovery, then on average, you're going to get 10%. 10% of the loan is worthless. And I'm going to make some kind of hand-waving assumptions here or there. But you can assume statistically, and since this is a large number of borrowers, it's 1,000, right? If there's only one borrower, it would be hard to kind of gauge when he defaults. If he defaults at all, we would just know that there's a 20% chance. But when there's a large number of borrowers, you can kind of do the math and say, okay, on average, 200 of these guys are going to default. And instead of actually getting a 10%, since 10% of the loans are going to be worthless, I'm going to get 10% less than this 10%. So I'm going to get 9%. So this is based on the model that we just constructed, right? This is the model that we constructed. This is a much simpler model than what most people use. But based on the model that we just constructed, I think the real return we're going to get on this mortgage-backed security is 9%. If there was another investor who assumed a 50% default rate but with a higher recovery, he or she would have a different kind of expected return from this security. So why is this even useful? Well, think about it. Before, in the case we did in the first video, when someone just borrows from the bank has very specific lending requirements. They have their own model. So there's a whole class of borrowers that they might have not been able to service. Right? There might be people with really good credit scores, really good incomes who don't have a down payment. And if they don't meet what the bank's requirements are, they'd never get a loan. But there are probably some investors out there that would say, you know what, for the right interest rate and for the right assumptions in my model, I'm willing to give anybody a loan as long as I'm compensated for it enough. And this is what this mortgage-backed security market allows. It allows, let's say this group of borrowers, let's say this pool of borrowers right here actually didn't, this pool of borrowers right here, let me see something about this pool of borrowers actually aren't the traditional, they don't have 25% down, and they don't and they don't have the and they don't have kind of the traditional requirements to get a normal mortgage. But if I pool a bunch of people who don't have those traditional requirements, but they're good in other ways, maybe they have a high income or high credit score, I can go through this alternate mechanism to find investors that are willing to loan them money. So essentially, from the borrower's point of view, it allows more access to loan funding and they would have otherwise not been able to. And from an investor point of view, it allows another place for me to invest in. Maybe my specialty is, maybe I feel that the computer models that I have are really good at predicting things like default rates and recovery rates and what a loan is worth. And I feel that I can, in some ways, be a better loan officer than the banks. And this would be an attractive place for me to invest in. It's also, it just might just have a risk-reward characteristic that doesn't exist in the market already, and it allows you to kind of diversify into one other asset class. So that's the value that it has across the entire spectrum. Now in the next presentation, I'm going to show how you can, I guess, further complicate this even more so that you can open up the investment to even a larger group of investors. Because you can think about it right now, there's probably some people who say, okay, I already said, some people will do these models and try to make their own assumptions and say, okay, this is going to give me 9% a year. But then there's a whole bunch of people who are going to say, boy, this is too complicated for me. This seems risky. I don't have any fancy models. I only like to invest in things where I know I get my money. That's very highly rated debt is where I'm going to invest my money. And then there's another group of people who say, okay, 9%, that's nice and everything, but I'm a hot shot. I'm a gambler. 9% isn't the type of returns I want. I want to take more risk and more return. And so there should be something maybe for those people as well. So that's what we're going to show you in the presentation on collateralized debt obligations. See you soon. Welcome back. Well, in the last presentation, we described a situation where you had a bunch of borrowers. They needed $1 billion collectively because there's 1,000 of them. They each needed $1 million to buy their house. And they borrowed the money essentially from a special purpose entity. I mean, they borrowed it from their local mortgage broker who then sold it to a bank or to an investment bank who created the special purpose entity. And then they IPO'd the special purpose entity and raised the money from people who bought the mortgage-backed securities. But essentially what happened is the investors in the mortgage-backed securities provided the money to the special purpose entity to essentially loan to the borrowers. And then the reason why we call it a security is because not only are these people getting this 10% a year, but if they want to, let's say that you had one of these mortgage-backed securities and you paid $1,000 for it, and you're getting this 10% a year, but then all of a sudden you think that that the whole mortgage industry is about to collapse, a bunch of people are going to default, and you want out. If you just gave someone a loan, there'd be no way to get out. You'd have to sell that loan to someone else. But if you have a mortgage-backed security, you could actually trade the security with someone else, and they might pay you, who knows, they might pay you more than $1,000, they might pay you less, but there'll be some type of a market in the security, so you could have what you could call liquidity. Liquidity just means that I have this security and I can sell it. I could trade it, just like I could trade a share of IBM or I could trade a share of Microsoft. But like we said before, this security, in order to place a value on it, you have to do some type of analysis of what you think it's worth, or what you think this real yield or this real the real interest will be after you take into account people prepaying their mortgage, people defaulting on their mortgage, and other things like short-term interest rates, et cetera, et cetera. And there's only maybe a small group of people who are sophisticated enough to be able to figure that out, to make some type of models, and who knows if even they're sophisticated enough. So now there might be another investor here. Let me make my pen tool work. There might be a whole other class of investors. Where is the pen? There might be a whole other class of investors. Let me draw it here. Say this guy, he would love to kind of invest in securities, but he thinks this is too risky. He'd be willing to take a lower return, but as long as he was allowed to invest in less risky investments. Maybe by law, maybe he's a pension fund or he's some type of a mutual fund that's forced to invest in something of a certain grade. And say that there's another investor here. Oh, I don't know why my pen keeps changing. And he thinks that this is boring, 9–10%. Who cares about that? He wants to see bigger and bigger returns. So, and there's no way for him to invest in this security and to get better returns. So now we're going to take this mortgage-backed security and introduce one step further kind of a permutation, or I guess a derivative of what this is. And that's all what derivatives are. You've probably heard the term derivatives, and people do a lot of hand waving saying, oh, it's a more complicated form of security. All a derivative means is you take one type of asset and you slice and dice it in a way to spread the risk or whatever, and so you create a derivative asset. It's derived from the original asset. So let's see how we could use the same asset pool, the same pool of loans, and satisfy all of these people. Satisfy this guy who wants maybe a lower return but lower risk, and this guy who's being willing to take a little bit higher risk in exchange for higher return. So now in this situation, we have the same borrowers. They borrowed $1 billion collectively, right? Because there's 1,000 of them, et cetera, et cetera. And there's still a special purpose entity, but now instead of just slicing up the special purpose entity a million ways, what we're going to do is we're going to split it up first into 3 what we could call tranches. A tranche is just a bucket, if you will, of the asset. And what we're going to call the 3 tranches: equity, mezzanine, and senior. And these are the things that are these are the words that are commonly used in this industry. Senior just means these people, if this entity were to lose money, these people get their money back first. So it's the least risk out of all of the tranches. Mezzanine, that just means next level or middle, and these guys are someplace in between. They have a little bit more risk, but they still get and they get a little bit more reward than senior, but they have less risk than this equity tranche. Equity tranche, these are the people who first lose money. Let's say some of these borrowers start defaulting. It all comes out of the equity tranche. So that's what protects the senior tranche and the mezzanine tranche from defaults. So in this situation, what we did is we raised, out of the $1 billion we needed, we raised $400 million from the senior tranche, $300 million from the mezzanine tranche, and then $300 million from the equity tranche. The $400 million senior tranche we raised from 1,000 senior securities, collateralized debt obligations. These are these right here, and they each say say there were 400,000 of these, and these each cost $1,000, right? Where'd my pen go? Pen. Oh, I need to make sure I'm on the right layer. So let's say these cost $1,000, and we issued 400,000 of these, so we raised 400. What, my pen messed up again. So we raised $400 million, and let's say we give these guys a 6% return. And this is, you might say, oh, 6%, that's not much. But these guys, it is pretty low risk, because in order for them to not get their 6%, the value of this $1 billion asset, or these $1 billion loans, would have to go down below $400 million. Maybe I'll explain. I'll do a little bit more math in another example, but I think it'll start making sense to you. For example, every year we said there's going to be 100 million in payments, right? Because it's 10%. 100 million in payments. Of that 100 million in payments, 6% on the 400 million, that's 24 million in payments, right? So 24 million in payments will go to the senior tranche. Similarly, we issued 300,000 shares at $1,000 per share on the mezzanine tranche. This is also 1,000. This is the mezzanine tranche. And let's say they get 7%, a slightly higher return. And these percentages are usually determined by some type of market or what people are willing to get. But let's just say it's fixed for now. Let's say it's 7%. So 300,000 shares, 7%. These guys are going to get $21 million, right? So out of the $100 million every year, 24 million is going to go to these guys, 21 million is going to go to these guys, and then whatever's left over is going to go to the equity tranche. So the $300 million from equity, they're going to get $55 million, assuming that there are no defaults or prepayments or anything shady happens with the securities. So these guys, I don't know why my pen has stopped working, but these guys are going to get $55 million. Or on $300 million, that's a 16.5% return. And I know what you're thinking, boy, Sal, that sounds amazing. Why wouldn't everyone want to be an equity investor? I don't know, my pen has stopped working. But anyway, I'll try to move on without my pen. So you're saying, why wouldn't everyone want to be an equity investor? Well, let me ask you a question. What happens if 10%, let's go to that scenario where we talked before, that 20% of the borrowers just say, you know what, I can't pay this mortgage anymore. I'm going to hand you back the keys to these houses. And of that 20%, you only get a 50% return. So for each of those $1 million houses, you're only able to sell it for $500,000. So then, instead of getting 100 million per year, you're only going to get 90 million per year. I wish I could use my pen. Something about my computer has frozen. So instead of $100 million a year, you're now only going to get $90 million a year, right? And all of a sudden, these guys are not going to be cut off from. This guy's still going to get 24 million. This guy's still going to get 21 million. But now this guy's going to get $45 million. So he already got, but he's still getting a above average yield. Now let's say it gets even worse. Let's say a bunch of borrowers start defaulting on their loans, and instead of getting $100 million or $90 million per year, you start only getting $50 million in per year. Now you pay this guy 24 million, you pay this guy 21 million, or this group of guys or gals 21 million, and then all you have left is 5 million for this guy. And 5 million on $300 million, now he's getting, it's like less than a 2% return. So this guy took on higher risk for higher reward. If everyone pays, sure, he gets 16.5%. But then if you start having a lot of defaults, if let's say the return on what you get every month goes in half, this guy takes the entire hit, so his return goes to 0%. So you had higher risk, higher reward, while these guys get untouched. Of course, if enough people start defaulting, even these people start to get hurt. So this is a form of a collateralized debt obligation. This is actually a mortgage-backed collateralized debt obligation. You can actually do this type of a structure with any type of debt obligation that's backed by assets. So we did this situation with mortgages, but you could do it with a bunch of assets. You could do it with corporate debt. You could do it with receivables from a company. But when you read about the most right now in the newspapers is mortgage-backed collateralized debt obligations, and to some degree, that's what's been getting a lot of these hedge funds in trouble. And I think I'll do another presentation on exactly how and why they have gotten in trouble. Look forward.